But did you hear his plan? He's giving out almost everything.
But as far as he's alive, he's still going to continue.
His kids are only getting $10 million each.
They are made. $10 million.
He said he wants to give them, doesn't want to give them so much that they will not work again, but he wants to give them enough that they can at least start something.
And forget the 10 million. You know what they are already doing.
They are ready to, yeah.
Yeah,
you
you
know?
feel that $10 million is bobo.
Bobo.
It's big
No,
bubble.
he will actually hand over the 10 million if he accepts it. But forget that
There are
also
several
that
things. I'm
Yeah.
sure that
maybe
because they said all the apartments too that is selling them. They said all, okay. I mean, I still feel saying that bobo.
that's the only pot in his name. The only pot in
Have you?
Their own name or shell company.
Oh yeah. So if you look at the income statement that we imported, this is it. So we have revenue line here, we have cost of sales line. So what analysts do when they get historical data is that they want to know the composition of this. Does it have any breakdown? So that's the first thing. And why do we always want breakdown? It's for us to actually check the drivers of each of the components. What drives A, subdivision A, might not be what is driving subdivision B. Might be different things. So we want to actually separate them and model them and forecast them separately with their drivers. That's why we always want to dig down into what is the composition of this thing, So for revenue, if things like divisional revenue or segment revenue can be the breakdown, so that you can then know what each of the segments is growing at, what is the growth rate in each of the segments. So it might be one particular segment that is actually contributing to the company's revenue. So as analysts, you want to actually check that, so that it can be part of what you are going to be revealing in your presentation. So cost of sales is another item that we want to check, particularly for manufacturing organizations that include depreciation in their cost of sales, because they use machines for manufacturing these products. So most often than not, they put depreciation inside the cost of sales. And so you need to confirm what is the proportion of depreciation that is inside the cost of sales vis-a-vis what is inside the marketing and distribution and admin expenses. You understand? So that is why I went to let me bring up the latest annual report 2021, this one. So when we went into that, we were able to break down Control F, depreciation. So I can see depreciation in the cash flow statement. So cash flow statement, like I said in that video, is one statement that will enable you to actually know those non-cash items, because they are going to be adjusted against the profit for the year in the cash flow statement. So this is the depreciation figure, and it is 8.4 million in 2021 and approximately 7.8 million in 2020. So I want to see note 15, like they say, so I continue to press next. So this one talks about how IFRS has said they should recognize revenue and what they have used. So the company is actually recognizing revenue on a straight line basis over estimated useful life. So all these can be read as well. So modelers read all of this, and that's why they are conversant with every item in the financial statement. They know how the financial reporting guys have derived them, because we read all this. So you can see let me bring it up. The estimated useful life for the current and comparative period, which is 2020 is the comparative period. This is 2021 financials. So this is the useful life of the assets, building 20 to 35 years, like that. So they are just doing disclosure requirements as IS 16, which is on property, plant, and equipment, as told them to actually show in their financial statement, which is good for analysts. They know the rate, the depreciation, the useful life on which the assets in the balance sheet have been depreciated. So it's one input that we need to drive the depreciation that is calculated in models. Understand? So, but that's not what I want. I want to see whether depreciation is inside the cost of sales, right? So I keep on pressing until I get to, I guess it's a note like that. So look at this. So information about reportable segments. So they've got food segment, beverage segment, and unallocated. So under each of their segments, they have external revenue of these amounts, interest income, they tag it as unallocated, because they can't directly attribute it to any of this. Then interest income, interest expense, then depreciation. But depreciation, they were able to allocate it to each of those segments. So definitely they are part of that. They will be parts. You can assume from here that they will be part of the cost of sales, because cost of sales is the cost of the item that is sold. Now, but what will actually give you a clear cut is for you to see what note 11B is. If we have 8 million in 2021 and 7.8 million in 2020, inside this figure of 219, 2021, which is this year, 219 and 161. So that's exactly where we are going to. But this gives you an indication that this depreciation is actually a direct thing. Don't forget the total of our depreciation, that is charged, that we saw in the cash flow statement the other time, is this figure, 8.4 and 7.8, right? Which is, all of it has been directly traced to the segments. Okay, so I'll continue to press that. Okay, so these are the expenses that were charged before the profit before tax, before deriving the profit before tax. And so they've given us depreciation and amortization, the same figure. Audit, remuneration, director, personnel expenses, loss on PPE, exchange loss, and this. But this is not giving us any indication. We need to still move ahead to see where we can. So they gave us expenses by nature. So depreciation is part of this, but this is not giving us what we want. We want. Okay, so if we have depreciation expenses by nature, what other classification do we have? We have personnel expenses, of course. Depreciation, if included in marketing and distribution, should be, no, it shouldn't be part of this, but we need to see the breakdown of marketing and distribution, admin, and cost of sales. So we can see it here. This is also, okay, this is still under personnel, talking about how many people are remunerated. So this is tax. So we can see that the information that will require, or better still, let's search for cost of sales. Cost of sales.
And you're almost there, sir.
Enter. I guess it shouldn't be far from here. No.
It's 15, it's 15. This is 19.
Let me move first. Where's my cursor? Oh, yeah. $15 is property asset schedule. 14 EPS. 13 No, I think it should be up above what we saw.
Isn't 15?
15 is asset schedule. The
15
note
B.
said, the note actually said 11, and this is 11. So 11B.
See? Okay.
The notes against, yeah, it says 11B. So that's where, and it is not explanatory. So this is what you get in, sometimes you are not giving detailed information of what you want, what you're actually looking for. So they've got, okay, this is it. So you can see 219167, right? 219167. So, but then it is the composition of these that we want. So, but I'm saying the total of these three is being done here, meaning that each of these breakdown of these are all here.
Yeah.
So they didn't actually separate it. So we then need to start going there and say, oh, where do you belong? You know, like this now, we can't actually place it anywhere because it could be in any of the three. It could be in cost, it could be in marketing, it could be in admin.
Some people use admin.
You know, yeah. So for service company, they will always want to push it under admin. You always see their depreciation under admin. But for manufacturing, most of the time you see it under cost of sales. So you can see now that you have limited information. But it's only if you have an insider person that you can then ask, or probably you are the modeler for that company and say, okay, please give me the breakdown of this cost of sales. So that's how we know information data to ask for when you are modeling for a particular company, because you actually want to bring out depreciation, non-cash expenses out of all your expenses and separate them out. So we want to know the components. So for this, we do not have that composition. The best bet you can start doing here is to say what is the possible. So you can say raw material and consumable will be cost of sales, right? Yeah. And what is the figure? 163 out of 219. So what other thing can you put in there?
Credit loss on receivables.
On receivables? No, that can't be. That will be under marketing and distribution.
Yeah,
really?
Yeah, so it's just like bad debts.
Yeah, it's more
just like bad debts.
It's actually bad debt.
Yes.
More on the distribution expenses.
Yeah. So advertising is marketing and distribution, sales promo, factory overhead, yes.
Yeah, also.
So if we add these two now, so this is 18. Let me copy this. Control C. And this one is not well defined. Can you see other expenses? So if we add this, what do we have? So these are the analysis that modelers do too.
You know what just came to my mind? Since marketing and distribution expenses already in our financial,
yeah,
and administrative expenses, let's go to those three line items. Those three that show the total. If it is the same figure, then every other thing is the cost of sales.
I get that. Okay, that's another thing. Yeah. Good. So you can see that this one is 7 weight. Am I the one that didn't do the right thing? I added 2, 1. No, I should subtract. So since that one is minus already, let me see what I did first. No.
It should be
67 plus this one.
Yes.
Plus this.
Yeah, correct.
Is that what I should do?
Yes.
No. You know why? I'm to add these two to see whether it will total that figure.
Okay.
I'm to add these two to give us our cost of sales. Right, that's it.
So it's about 182.
So 182. So what is the difference? So 219 and 182 was our figure. So you can see 37. So, and the depreciation we are looking for really is just 8 million, 8.4 million. So it means there are still other composition of cost of sales inside here. But looking at it, you other expenses is 14, and we are looking at 37. 37 is our balance. So you can see that there is no way we can get it. Even if you go through that method of yours, it would still amount to which expense will you categorize as cost of sales in this list? You know, none. Other expenses include product research, so they've defined our other expenses. Include product research and marketing expenses, product related overhead, donations. So definitely is a candidate of marketing and distribution. You know, so that's why I said don't ever put anything miscellaneous. You must define every item you put in your model. So you can see if they have not defined this. This is the question I need to ask.
Now
What is other expenses? You know? Okay, so now that's why when you don't have that data, you then need as analyst to make your decision and back up your decision with a write-up that you're going to put in there. So we went, when we were searching for depreciation, we saw that depreciation was allotted by segments. So we can assume that depreciation is closely related to items sold. As such, it should be classified it is assumed to be inside the cost of sales. Is that clear? So there are times, just like we have this scenario now, there are times that as analysts, it will be difficult for you to see the data to actually make your assumption. But there will be some indication that you see that will make you say, oh, there's a higher possibility that this thing is, it might not be totally inside, but a larger portion of it will be inside cost of sales. Because it is expected that in Nestle, at least we have an asset that they will depreciate for admin expenses, for administrative purpose, for marketing purpose. They will have some assets which they will depreciate, and it's expected to be inside the marketing and distribution and admin expenses. So, but the data is not here for you. It's only if you have that insider view that you can ask for those information, and you'll be granted. So as analysts, we find ourselves in situations like this, which you need to make that assumption and move on. It's not for you to say, no, I'm not assuming anything, forget it.
In fact, the cocoa is the move on.
So for instance, if I put in for FM or FM,
yeah,
and so I get to
something like this. That's true.
What would you recommend?
I don't understand. If you
get
get
exam
hall,
FM.
I have something like this to model. What would you recommend?
Yeah, that assumption, the same thing you give. Like I said, analysts always look for data to base their assumption on. We have looked for that data. It's not inside their annual report. So the alternative you have is to ask people inside for this data. Sometimes you even ask those who are inside. They will tell you they don't know.
But in finance teams,
And sometimes they will have it. They will not want to release it. So
some reasons.
yeah, so as analysts, inside that same report, there will be some things that will indicate to you that this thing, it might be this side, you know. It might not be a total, a total picture that you see. It's just an idea, an indication that there is likelihood of this depreciation to be inside of this. So what is that thing that indicated my attention to that direction? It is their segmental report that I saw. With that, and it's stated in your model, it's fine. It's fine, you know. I hope it's clear.
Yes.
So that's why if I model for a company, if another modeler take this model and model, that person might assume that the depreciation is in the admin expenses.
Yeah.
He might say, look, since I couldn't get any information as to the composition of cost of sales, I've assumed the normal, which is it is included in the admin expenses. So it's also fine.
And it won't be wrong, actually.
It won't be wrong. It won't be wrong. Don't forget, we are making assumptions as to what you as analysts can see based on your opinion. And that's why when we're advising, we tell them the basis upon which we're advising. And I do say that analysts do not give point recommendation.
Yeah.
You give a range. So that guy that has included in admin and you that have included it in, it doesn't affect profit after tax. It's still going to be profit after tax. You understand? So it's not going to be too far from each other just because you have assumed that depreciation should be taken from this. The only thing is that when you are checking the trend of where you have removed it from, then there might be some off balances somewhere, you know. So please take note of that. So I'm going to put it in the comments, shift F2, that depreciation is assumed. Didn't I commented on it in the last one? Yeah, I think I did. So depreciation included, but let me give the indication.
Yeah, that's true. We have to delete the former cost of sales.
Yeah. So depreciation included in cost of sales has been deducted and given a separate line item in the statement. Okay. Depreciation is, let me remove it. No, I should have added it. Is assumed to be included. Is assumed to be included in the cost of sales, and in order to forecast depreciation, same figure has been deducted. Okay, so I'm right from here. Has been deducted and given a separate line. This assumption, so modelers document a lot. You write what you have, the basis upon which you are actually deriving your figure. This assumption was based on the indication
So I can lock,
from the segment report.
if I lock my model, you'll still be able to read the
Yeah, you still be able. Don't forget, it's just to hover on it. You'll
Yeah.
still be able to read it. Okay, so depreciation is assumed to be included in cost of sales, and in order to forecast depreciation, same figure has been deducted and given a separate line item in the statement of profit or loss. This assumption was based on the indication from the segmental report. You can even quote the line. So modelers document a lot. So I'm trying to navigate to that segmental report. No. Okay, so this is it. So which page is that? So they have operating segments.
Where was that page?
That's I'm trying to check the page. Page 72, note 7, information about reportable. So you can quote this. Okay. Am I going to remove this? Information about.
I'm trying to remember.
Okay.
Shift F2.
Yeah. Shift F2. Yeah.
Yeah, to those projects.
Okay. So that's how we deducted. So if you look at this figure of cost of sales in our formal report, this is another workbook. The cost of sales is 21216, this one. So if you check the difference between what we have here and the cost of sales we have before, you see that, what am I saying? It shouldn't be this much now. 136 and 2, no. Hey now, it's 83. But our depreciation is 83. Oh, sorry, this is 2017. I should be talking about 2021.
Oh, yeah.
So 2021.
I'm trying looking.
I was surprised.
You were doing the right thing, so I was wondering.
2021. So it should give us 8 million, 8.4, so you can see. So we have brought it out from here and giving it a line. So remove it, deduct it from here. We should have 219 here as our cost of sales, but we have deducted 8.4. So that so give it a line. So this is splitting. This is what we call splitting of line item.
The cost of sales is already okay. That's what the notes actually capture.
Yes,
it's less of depreciation.
Yes, it's less of depreciation. So this
so that we can have that separate line.
Yeah, so that we can have that separate line. You, Gary.
Sorry. While I was watching the video this morning, I wanted to confirm.
Okay.
Duplicating those sheets is how we are able to ensure that what you have in your input is on the same row and column.
Thank you. Yeah.
Because if you are creating it yourself, he might move to error.
No, right, you kept emphasizing. Input sheet. Not any other sheet. Input sheet. So even if you have created valuation and you want to create chart, still go to the input.
Yeah. So very important. And that's because of our fast standard that I said there needs to be consistency of the columns in our model.
Then another thing again is because of that single one thing, everything is now, since input is linked to timeline, everything will be linked to timeline. So if you want to make a change,
Just go to
just go to
timeline.
timeline.
Thank you. I like that. I mean that observation you made because we have replicated the timeline. So all the time are now
Good thing.
being fed from the timeline.
So we are going to change anything about time.
Yeah.
Good thing, right?
So you have to
Let me
go
change 2019, 2019. Now go across
every sheet.
So maybe someone made mistake. It was not meant to start from 2017. Instead of now going to go and change 2018, just change at once. You will replicate so everything.
So it means your model is dynamic.
That's how it should be actually.
You know. Okay, let's move on. So
Then,
I've explained that, right?
Okay, finish this one.
I've explained this. It's only remaining this, right?
Yeah.
So this is another item. What is equity share-based? In fact, let's talk about share-based payments. Share-based payments can be found in your balance sheet as well. Let me try and navigate back to the balance sheet. So if you look at your share capital, your equity, can you see share-based payment reserves? Now, share-based IFRS 2 is what is actually tackling this share-based payment reserve. So an IFRS 2 is saying that if you ought to pay your worker in cash and you give them shares, then it means invariably they are part of the shareholders.
Yeah.
But please don't add it to issue share capital because those are normal who paid for the shares. This one did not pay. You are the one that gave them the company shares. So separate it and call it share-based payment reserves. So companies also pay their suppliers for goods in shares. They say, look, don't worry, we'll give you this number of shares. When you supply in 30 days, when you supply now in 30 days time or in 6 months time, whatever is the share price of our shares, the price of our shares, we'll give it to you. We'll give you at that price. So instead of crediting cash and debiting purchases of that goods, so they are not going to credit cash, rather they are crediting share-based payment reserves.
I did this in Nike and I forget to pass complete reports.
No, the thing with accounting is you are not. It's just like this modeling thing. You have to continue to.
No, especially those IFRS.
IFRS. I wrote. At least I attempted deep IFRS now. So, but my work, my daily work
doesn't require so.
But when I need to do anything like that, I can always brush up. It will be different from somebody who doesn't know anything about it.
But my own mindset about this IFRS thing, because I've seen, I do not see it different from what we used to have. If I had it to issue check out, what is the difference? Because before now, we also passed this.
No, the thing is,
we passed that.
If they added it to issue share capital, you'll just be seeing, wow, people actually subscribe.
It's not be like a true
picture.
Exactly.
So I guess that's the only thing I see that IFRS is coming to do.
Yeah.
Just for transparency.
Yeah.
But the technicality is still there.
It's still gap.
It's still there.
the gap is still.
It's a gap that we're applying. You know, because you can't say because it's IFRS, I should not credit share capital. You know, I mean equity will still be credited, whether it's in share capital or it's in share-based payment reserve. You know, so now, you know, when you want to pay your employee ordinarily, what you do is you are going to debit your admin expenses. Right? You're going to debit your admin expenses and then credit your cash for that. But now, you are not crediting share-based payment reserve and you are still debiting your expenses.
Yeah.
So your expenses is still being debited.
Yeah.
You know. Now, so here, the share-based payment reserve does not involve movement of cash.
Exactly.
And that's why we're saying, look, come and give it a line item, because this thing we didn't pay. Look at it. Bring it out of the expenses. Those ones that you posted. So in the
So don't let my profits, that operating profit, be so high when this should have reduced it.
yeah. So you cannot, if you have paid your what do you call it? If you have paid your staff in terms of shares, then you'll be taking it as an equity settled share-based payment transaction. You know. So, and that's why we have brought it out.
Yeah.
From
introduce EBITDA and EBIT.
yeah, so that we can then introduce this. Because before now, what we had, if you look at the former one, what we had was results from operating activities. So how did we get results from operating activities? We subtracted cost of sales from revenue, right? We got gross profit. So gross profit minus these two, marketing and admin, we got results from operating activities. And result from operating activities is our EBIT, earnings before interest and tax. That's our EBIT. Or you can call it operating profit. But IFRS has said they should call it result from operating activities. But same thing as operating profit or EBIT. So, but as analysts, we always show EBITDA on the face of our income statement. Like in this one, they don't show EBITDA. Because EBITDA is used to make decisions, buying decisions, selling decisions of shares a lot. And that's why analysts always show EBITDA on the face of the income statement. And the difference between EBITDA and EBIT is just the DA, the DA, depreciation and amortization. You know. So, and that's why we have brought that depreciation out and also show EBITDA. Where is it? Okay, so and that's why we show EBITDA. So EBITDA is very close to cash profit, because every item here now does not all involve movement of cash. You have paid for it. You can accrue or will pay eventually. Understand? So EBITDA is shown. When investors want to buy a company, they will say, I'm going to buy 10 times of your EBITDA. What is your EBITDA? You know, so your latest EBITDA is 80 billion. They can say, to buy this company, I'm buying 10 times of EBITDA. You know, so the more EBITDA you produce, they feel the more cash profit they can get when they buy it over and start running it. You know, so so I hope that explanation is clear. Even though some persons still argue about the equity share-based payment transaction, that it should not be a non-cash expense, it should be allowed,
as
you
a
know,
cash
as a cash movement.
because some companies might be using it to. Yeah,
So,
I was thinking about it.
So the argument is there for this. So
Sorry, come again.
this share-based payment, some persons still feel that it is not a non-cash expenses, so it should be allowed to fly. Meaning that the company has given you their shares. Yes, they didn't pay any dime for it, but don't forget, they are going to issue the shares to you. They are going to issue the shares to you. So instead of their cash to reduce, it is now an effect on the shares. And the effect on the shares is that it's going to dilute the shares.
Yeah.
Meaning that if the shareholders have been getting dividend per share 2 naira before, it will be lower than 2 naira, because invariably they are saying, look, company, you have paid.
Yeah.
this money has been paid, movement has been done. And so that argument is on that. So if you treat it as a non-cash, another person can decide that, look, on the basis of that justification, I'm not treating it that way. And so that person will only be having this line. So please take note of that.
So I had to ask that question because I recently, something like that happened where I work. We usually get share-based payments every month.
Share option.
Yeah, it's not even an option. It's part of the package.
Oh.
Every month you get shares.
Oh, that's
But
good.
in recent times, I think after the last AGM, they just started giving us the cash instead of the shares. So when you talked about shares dilution, it's possible
That
some
the
of the
shareholders-
major shareholders,
They oppose
yes,
it,
you have
uh,
declared this amount for dividend, but we're not seeing the effect because
Yeah.
your staff.
Staff.
So give them, if you want to, you give them the
Give them cash.
So they just told us that it's a temporary arrangement, that
Mm.
eventually we'll still continue to get the shares.
Yeah.
So it's a possibility.
Yeah. So it's not like you, so you can't compare it like a depreciation that you can't pay any cash. It is strictly you are just it's something you have paid for. You are just there. You are just amortizing it over some years. This one you can pay it in cash, or you have that option of doing that, and that's the basis of the
so this kind
of
of
the
thing,
argument.
should it be agreed with the client before you do it?
Yes. So like I said, everything you do in your model needs to be agreed with the client. Now you have built this income statement. Probably you've not even started forecasting. You are tearing their historicals apart. So you need to actually carry them along and say, okay, we'll finish analyzing your historicals, and this is what we noticed. So can you share your idea? What's your take on this line? So you hear them out, and you also, but as analysts, you know the two sides, and you should be able to weigh and say, okay, let's let this one go.
Because the reason why I ask is, if I finish using those two, and then I finished, and the client says that no, I don't want to recognize more.
No, it's even easy, and that's why.
I easily just delete.
Yeah. So that's why the way we model here, it's easy for you to take it out. Unlike how some persons model, and that's why sometimes when I see some model, I just shake my head. That if any little thing is taken out from here, everything goes off. But the way we model here, it will not.
Just that
Because
one line will not hurt.
It will hurt, but we usually do a bulletproof on the model. So we turn it, how will I put it now? Let me try and bring up
So you're still going to just bulletproof in this class.
That's why I said we are going here, but you guys are not moving with that pace. Let me try and see if I can get a model where no.
We have just 4 weeks to go.
It's in the other laptop.
It's okay. We have just 4 weeks to go.
Yeah, so we just have to rush things. And what I would do is I will do more videos like that and send across to you guys. So even if it is to discuss it in class like this, I think it's better. And please replicate.
I've been able to go through all
Replicate.
the videos you sent yesterday.
It would
This much
more helpful. So so that's the idea behind this. So like I said, it's easier because of the way we build model. If you take out an item in some models, you see errors all through. So what we'll do is that we'll break the error. So we'll call it circuit breaker. Just like you turn something is burning in the house, just turn off your circuit breaker because you perceive smoke, So when the electrician come and rectify that issue, he will turn on the circuit breaker back. That's what we do. So in the model, we took something out. In fact, before you take it out, we switch off the circuit breaker. So we take whatever we want to take out, then we switch it on, and everything is normal.
We have not thought of that.
So those are the ending work, protection, circuit breaker, and all of that. Those are after model work.
So one of our consultants that we use, what they do is just like the question you asked. Almost every day or every 2 days, they are sending updated models. So what they do is once they send out, they're expected to have a session so where they go through what they have done. So all these things they have done, they will come and explain to us.
Yes.
So if you have any objections,
Which
still
things?
have from them.
Yeah.
And via mail, you tell me I can continue.
And you guys, I mean, in that meeting, the meeting will have a conclusion. We have concluded on this thing should be there, this one should be there, this one take it out.
For me, it doesn't work that way.
Because you guys just accept.
With the model I'm using now, we had concluded something, evaluation. We concluded like a month ago. But up to Friday, we still had another meeting. Because we feel because of the heightened level of oil theft, we feel that asset that is valued, we expect an increase in demand for that asset because it prevents oil theft.
Okay.
So they have done the evaluation, giving us a value.
Okay.
But because we see the demand for this asset is going to rise because the drilling, it's a pipeline. They didn't do horizontal drilling. They did vertical. So it went into the air.
Okay.
So you cannot vandalize it because it's not on this. You have to continue to go ahead. So we see that people are going to, demand for that asset. So this value that they have given us, it's not, so we need to look at it. But they had concluded the whole thing like a month ago. Still just call them back. Come on.
But for me, it's a new contract.
No, what I'm driving at.
It's a major revision.
Why? Let me see. Why I said it doesn't work like that in real life most times.
Yeah.
It's because before we went back to them, we had started dangling the carrot in front of them that way. We had seen what they did, and we feel that we need to bring them on board to be our financial advisor.
Okay.
And so we have started dangling that carrot. We have not concluded it. It's still an ongoing conversation.
Okay.
Right? But we feel that you have the technical depth to be our advisor. So, but pending when we conclude that, please, you need to look at this valuation again. So, if they had said, you have to pay me, they know that something is still.
They say,
so that's
okay,
how
I see. Okay, no problem. No problem. All right. So that's how we've been able to separate EBITDA and operating. So you can see that the operating profit, instead of me naming it, how they named it, results from operating activities. That's what is in the report that we imported.
Yeah.
But analysts will not give it that name. We'll give it either operating profit or EBIT. It's even for learning purpose that I slash it.
It's supposed to be just
Ordinary, I will just put EBIT. So because students also go for interviews and they ask them, can you explain what operating profit is? And you begin to hear, differentiate between operating profit and EBITDA. So and that's why in training we hit on those points so that when they ask you to talk about the income statement of an analyst, you are able to say from A to Z and say, okay, we start from revenue, and revenue is this and this, cost of sales is this, and then you get gross profit, then you get
as you're talking, just reminding me of interviews that you just say, do you know how to model? Yes, walk me through the model.
Yeah, so that's the most popular question. Walk me through. True,
Then if they want to be more advanced, they'll say, what deals have you worked on? They will look at your CV. You said you have worked on this deal. Now, this particular deal, walk me through the deal and the financial model. So you have to first start for how you got the mandate, all those things. Then you now start to, oh my God, if you don't know it, I'm embarrassed.
If you don't know, you won't be able to answer it. Sincerely.
That's why I tell people that don't just put a deal that you were not really active on. Post 4. If it's a 4 that you are active on, don't go and put it so that
Perspire to Maguire, you know. My friend, I had a colleague that left my team. He's in Canada now. He's looking for a job. It's just my transaction, the deals that I did. Yeah, I did because he wanted to. We saw an opening somewhere, and I had to do with it. So he now called me. I have an interview. Explain this transaction. So I was typing everything for him on WhatsApp.
And the funny thing is that he will just
Yes,
he will
he's smart.
explain it very well.
He's smart, you know.
Yeah, he can go.
What you just do is everything that was you turn it to him.
Yeah.
That's
I
what
can
I did.
remember,
I explained everything to him on WhatsApp. I
Wow.
typed
I won't even lie, I've done something like that before. I was talking as if I was the one that went to get the offtake agreement, so we went to get the offtake agreement. And now we with the guy we just do the paperwork. But the way I said it was as if I was the one talking to Ondo State governor.
I didn't go in front of
So we met the governor. We had an agreement, the MOU. Then of course we had to get the offtake agreement with several other participants and investors that wanted to work with us.
So that's
seriously. In their mind they were like, oh boy.
Of course.
But now they do proposal like.
You always do better. You were even in the blue.
I was with you, I was actually in the blue.
Yeah.
Now, it's different from somebody who knew next to nothing about so.
Okay. Oh yeah. So let's continue. So that's how we got our EBIT. And finance income is there on the face of the income statement.
Finance income. I have a question.
Okay, please ask.
Now it was minus before. It was negative.
What's negative? No, this one. All the costs are negative before.
Yes, it was negative. The finance cost, of course, we just used Control H.
Yeah. Good.
We used Control H. Then
So this is it.
Yeah, the finance income. The
finance cost. So wait, you said you use Control H?
Yes.
So
I
highlight
find and replace.
Control H.
Okay, yeah.
Minus, you put
okay.
and replace with all, right? So to remove all those minus.
And the finance income,
So I did something to add minus to all of this. What did I do?
Okay.
But why add minus? I thought you said the positive
Normal for cost.
That's what I wanted to
Yes,
ask
for cost.
in the
So
sense
how
that-
we are adding negative?
Okay, so good. I like that question. So it's a two-way thing. It's either just like it's either we remove the minus and just put. I think that's what we should even do. That's what we should do. You are right. You are right. After all, that's what we should do. So how do we get? That's what we should do. So Control H and replace with nothing. That's exactly what we should do. I confused you for something else. So
Okay, but
so here, if you look at the calculation, I should have done the calculation here instead of me doing sum. So I should do this.
Okay.
But guess what? I'm doing minus this
minus.
and this. So this is what I should have done.
Oh, okay. Yes, boss.
But it
but
changed.
excuse me, finance income shouldn't it be added to the EBIT?
Shouldn't it be added to EBIT?
Yes. Is it not an income?
Okay, yes, it's an income. Good. So we first want to get the net first.
First have to get the net.
Okay, net, yeah.
Then here we then add it. We then do a subtract. You can see that it's excess of cost. So that's why I subtract.
It's net finance cost.
Yes, that's why it's net finance cost.
Yeah.
Even in financial service annual reports, you see them doing net interest.
Yeah, net interest. Yeah.
You know.
The banks.
NIM.
Yeah. So
No, because me, I still left it as minus. So
yeah, you can remove it. I think this is
So how
what we
did
should
you
have
add the
done.
minus? Control H, 2?
Yeah, Control H and just the way I did the first one.
That one will now be...
No, it's still the same thing. Nothing.
Nothing, then
Replace all.
with...
Replace all. Yeah, replace nothing.
No, it's asking how to put the minus.
How
right?
to-
Oh, how to put it. So if you do this, you will
You
not.
will now reverse the...
Now look at this.
It will not work. It will not work.
So this and you replace, right?
It will-
It won't work.
That's
So
why you use that one there. Yeah.
so can you see this one I typed here? -1. So you have to copy it. And here you can get to paste special.
HSV or HSV.
Yeah, this one. Or you press Alt HV. What's there? S, right? Paste special. Can you see? Alt HVS. So it brings up the page special dialog box. Then did I highlight this this line?
No, you didn't.
I didn't know. So you need to do multiply. So it's going to multiply this one by each of those cells,
Okay.
and it will then have minus. You can also do divide as well. So because I didn't, let me highlight now. Then sorry, I need to highlight first. So let me just I need to copy first, then highlight where I want to put it, then Alt HVS, and I then do multiply, then OK. So it multiplied the one by everything. So that's how I did that.
So you can as well say that cell, the first cell times the minus 1.
Yeah, you can
And
as well
then
do this. Yes, yes, yes.
R.
And lock the minus
Control
1.
R will not work. There's no formula here.
Oh, that was true. There's no formula.
So it's going to replicate this figure across.
Yeah, it's on. Yeah,
So I don't understand. If I said
because it's not a formula.
I copy the figure. I highlight where I want to. Sorry.
No, that's
I highlight this. Sorry. Sorry. And I did Control H.
No.
I mean, did I say Control H? Alt HVS. Alt
Let's
HVS.
multiply that first one.
Then multiply. And I did this. Then I replicate it.
To take
Control R.
it. Yeah.
Because there's no formula there.
There's nothing to lock. There's nothing
nothing,
to,
you know. So that's why.
I actually find this modeling very, very sweet. I was actually enjoying as I was replicating everything.
Good, good, good.
Actually, really enjoying. It's just that the part that you don't understand.
Yeah.
I don't vex will go and they enter. Then for the earnings per share part, the other comprehensive income.
Yeah.
I noticed that we deleted everything
Yeah,
because
yeah.
there's no change.
There's no change. It's the same. Yeah.
There's no point.
There's no point having them.
Then the SFP, do you want to quickly like just say one or two things?
Yeah, you can say one of those. So that we can, if we can start our inputs.
Okay, we can start input today.
Yeah, we can.
Okay, it's not really dependent on us watching those videos first.
No. It's not dependent on this.
Mm-hmm.
It's not dependent on this.
Mm-hmm.
So ask your question on SFP.
Okay, so question. The problems that I now forgot my notes.
Okay, so let me just explain what we did here. So on SFP, they started with
I'm
non-current
going to share
assets.
this video too.
Yeah, I'm going to share it. We started with, SFP starts with non-current assets. And the first person there is property, plant, and equipment. And that's IS 16,
Yeah.
you know. So they've given us that. It is just composed of all the assets that the company has, and it's in note 15A. And so note 15A in every annual report is the asset schedule. Let me call it, let me just type depreciation should get me there, because there is depreciation inside. This is it. So in every annual report, always look out for this schedule. So you see that they have this property, plant, and equipment schedule where they list all the items that is composed of this PPE. So PPE is just like a house name for each of the components of assets that they have. And in many of the annual reports, IFRS has I don't think, is it IFRS that actually told them about putting into land and building, but you see that in most all of it is categorized into these six items, which are land and building, PM, MV, FF, IT, and some companies do not have capital work in progress, while some we have. It all depends on the nature of the company. Yeah. So they classify all the assets, no matter how the nature of that asset is, they will push it inside any of these 6 heading or 5 headings as it needs.
Is it not when the work? Is it not when the completion of the business? I mean the item, each any of the item is completed that they are going to reclassify.
No. I'm not talking about capital work in progress. I'm actually talking about these 6 composition of the PPE.
Okay.
So I'm not talking about each of them. I'm talking about the composition. So, it will also be divided into costs, depreciation segments, which is this, and you then have your NBV, which is the carrying amount. So why is it called carrying amount? It is when you remove impairments. So impairment is probably your asset is you are carrying it in your book as 100 naira, but in the market it's 80 naira. So it has been impaired by 20. So you have to charge that. So that's impairment. So that's why they are not calling it net book value, but carrying amount.
If you notice that the audited account does not show the right impairment, can you add your own?
No. Babu.
You just have to work with the auditor.
They
will not even like you.
So for modelers,
Yeah.
it is dicey in you determining the carrying amount, the impairment, because you have to get the fair value of that asset. You understand? So you just have to use an average scenarios and project whatever has been coming and project it forward. Except if the company agrees that they are going to do they are going to give the evaluation of their assets to a valuer, then you can obtain the report of that valuer to know how much has been placed on those assets for the period of your model. You understand? Then you can do the impairment calculations. Okay, I hope I've been clear on that, right? So that line item is very crucial to the operations of the company. Analysts do not play with PPE, depreciation. You must get it right in that area because it's important. It's very key to the company's business. Then right of use assets. So this is another line item that is brought about by the IFRS we are talking about. And so before now we used to call it leased assets, but now it is said to be referred to as the right of use assets. And I mean, if you remember the Nigeria GAAP, then if a lessee has been leased an asset to use, and the lessee is using it for the major part of the useful life of that asset, it will be taken as finance lease, right? So, and it is said that, and that's where the substance over form comes, that the lessee is actually using a larger part of that asset, and so substance override that is the owner, So, and Nigerian GAAP said it should carry it as an asset, meaning the lessee, not the lessor, who is the owner, that the lessee should carry it as an asset and depreciate it. So the same thing is also happening here under IFRS 16. But IFRS 16 is saying the lessee is not the owner of the assets. The lessee only has a right to use the assets. And so it should not be termed as leased assets, but right to use the assets. And it is not a PPE, I mean, it is not a tangible asset. Rather, it's an intangible one.
Because it's a right.
because it's a right. Understand? So those are the ways where IFRS is coming in.
So how do you now value that right?
Okay, so just like with fair value tangible assets, they also fair value it and say, okay, on the basis of the right you have to use this asset, what is the value left on that right? You know, and this that will be done vis-a-vis the value of that asset that is under the lease.
So the lessor can still now report it as
An asset,
an asset.
but an intangible
But
asset.
the lessee will only report it as a right.
You say what? The
lessor
lessee
can keep it as an asset.
as an asset, but the
report it as an
lessee will keep it as a right, which is an intangible asset. So
I think we need to read up on this.
all these terms.
If I am to analyze this thing now, how do I, if I don't have the knowledge?
so
of it,
note
I think it's
15B,
even
that's why I'm
the-
here.
it's
Note
even-
15B, you can so when you take up financial annual report, they will write it there. So please read. The more you read, the more experience you gain. The more you read, I
Okay,
can't
let
get
me,
to this.
sorry, can I throw more light on that?
Yes, please.
Something. That is under, they call it IFRS, is this 17 or 16?
16.
16, IFRS 16. You know, like what they say, what the standard says is that, like what you said, the former CAP was talking about some lessees, you know, using, reporting a useful life, reporting the assets in the account. But in substance, it is the lessor that has the, that is the owner of the asset. But now they are now saying that for you to bring this asset inside your books, you should have, at least for the right of you, for the lease period, that is for the lease term. If the lease term is 10 years, so you have the right to use it for 10 years. You understand? So what happened is that those payments you are making over the period of years, you're making social payments first year, second year, third year, fourth year. So what happened is that that at the end of the lease, the lessor will collect a certain amount of money from you. You understand? So that amount that you are making, you have to discount it back. There is a rate they use, and that rate should reflect the rate in which you use in the what do they call it?
Your
Borrowing cost. Thank you. Borrowing cost.
Yeah.
Just like a similar
Yeah.
term loan, we have 10 years rate. You should use that rate to discount it back.
That will be a discounting factor.
Yes. So when you discount it back, you cannot wait till at that 10 years.
Sorry, before you go, so that's the rule. It must be the borrowing cost.
And
Or you can
the
use
rate should reflect
another.
the rate should reflect the lifetime of that use of that asset.
If you are going to get a loan for that time, that duration of time,
Yeah.
as a company, what is the rate you normally borrow? So that's the rate that should be used to discount the lease payment, the instrumental lease payment.
Mm.
So you have to discount it back to the present value. Are you getting what I'm saying?
I'm sorry, please. So that I can all understand this. I'm in a similar situation. So that borrowing cost, must it be what my banker is charging me, or what is obtainable in the market? Because what my banker is charging me may not align with what is obtainable in the market. My banker may be charging me because of certain things, or their own cost of funding may be very high. So in that regard, they charge me a high interest rate. But in the market generally, like
so the market rate will take superior over that one.
Okay.
Yeah, it takes superior over that one because the standard only said it should reflect your borrowing costs.
Why I was insisting that we should track that one down because in valuation, the higher the discounting factor, the lower the value of the asset.
Yeah.
You get.
Yeah.
So if my borrowing cost is high,
the value
will drop.
low. Yeah.
That's what I'm saying. That if I've gone to borrow money from somewhere and the rate is high, can I adopt in valuing my asset? Can I adopt What is obtainable in the market?
In the market, it's there. That will reflect it.
So please.
So okay. Let me continue. So what happens is that when you discount it back, you understand, it will come to present value as at that period in which you started the lease. You know, there's what they call inception of lease. Inception of lease. So now what the standard is saying is that you should, when you get that value, add other costs to it, other direct costs attributable to it in exercising that lease. For example, you have brokerage, all these broker fees, all these things. When you add it, it now forms part of that cost of the asset. Then in the future, you start depreciating the assets normally the way you are supposed to be depreciating other assets.
That's the lessor now, right?
That is the lessee. That is the lessee.
Okay.
Then when you have that discounted fact, that discounted amount will also have a credit value, which is to lease liability. That is what you will see under the financial side. That is under liability side. It's the same value, but because of other costs added to it, the value will be different. So for that right of use asset, you will just be depreciating it after you must have added other costs. That it comprises of discounted minimum lease payment plus direct costs plus other costs attributable to that asset. That is what you are using. You understand? So then
but let's break it down.
Okay.
Now, if you buy an asset, let's even forget about lease. If you buy an asset, probably you bought a mechanical generator.
Okay.
And want to use it for business. Now, we bought it for 1 million. But the seller told us that we will pay for the transportation to our place. And also, for us to install that plant, we need to call on the generator guy to mount it. Now, probably somebody say where you want to mount it to, you need to give us that land area, you need to pay, So, just like we normally know in Nigerian GAAP, that those are attributable expenses to the acquisition of that gen. And so the original cost of the gen is not just the purchase price, but the incidental cost as well is added to it. I don't know whether you get it. Because this is how we used to recognize the original cost of the assets that would depreciate. So that's exactly what it's talking about. That yes, you want to buy this asset on a lease, and they have spread the cost of the asset, the purchase price, they spread it in installments, maybe over 5 years. It's still 1 million you are paying, but they are saying pay it in 5 installments. So you pay 2020. Now, what about when you have discounted those 2020 to the present time so that it can reflect the time value of money? And that's why IFRS has said discount it using a rate that reflects your borrowing cost. So that you don't just put a figure in the moon as the cost of the asset you are depreciating. Now, that the purchase cost that you have discounted in this new standard IFRS is called the minimum list payment as against purchase costs.
Yes.
Now, but that's not the only cost of the asset. You need to add the incidental costs, and that's what it's talking about. Those attributable costs, you need to add it to the minimum list payment, and you get the original cost of the assets that you can then depreciate. So now, the minimum lease payment that you have, it is a 5 times installment you are paying. But you have gotten the total money you should pay, and you have gotten the discounted value amount of it now. So if it is 1 million, when you discount it, it will be like 800,000.
Yes, sir.
Right? Now, so it's now saying that this 800,000, it is what you need to pay to this guy. But the difference between 800 and 1 million is the interest charge that this guy has invariably put in it, because it is a financing component.
Yeah.
Saying that there is a financing component inside. And so that difference of 20 is the interest payment you are paying when you are paying the 2020K. So the 80,000, you will not take it as the liability you are owing the vendor. That I am owing him 80,000 as of today. When I pay the first 20, he will reduce the 80,000. So that is called the lease liability. It will be on the liability side. So as you are seeing the right of use assets, you also see this. So this is the cost of the assets that you are paying in installment, which you have not finished paying. So this is the amount that is left. So I hope you get that right of use and
there is a relationship
and the lease asset.
Yeah, it's clear now, but it's obvious that one will need to really read up.
So please read up.
I'm just thinking about a client explaining lease to me, and I'm just shaking that I don't understand.
do you know that
So that's why these IFRS gonna have to go and brush up, because imagine a client saying, why don't we consider it looking at IFRS 2 for instance now, and me maybe share base, that's dealing with share base payment, and me I'm just like IFRS 2 you know, like the clients have been looking at me that this guy is not flowing, whereas I know the stuff, but I don't know that he's talking about
When you are modeling, like I said, always read this the annual report. Even if you still need to go and read about IFRS standard 7 and say, okay, what does it mean? And most of the big fours have done interpretations of the standard. So read their interpretation and see what they mean. But you always see a write-up on each of those line items. And you can see the right of use asset comprise the initial measurement of the corresponding lease liability, lease payments made at or before commencement date, less any lease incentive received, and any initial direct costs. And that's what he's trying to explain. They are subsequently measured at cost less accumulated depreciation and impairment losses, right? So when you read these, right of use assets are depreciated over the shorter period of lease term and useful life underlying it. So you also see the theoretical write-up in their annual report. So the more you read them, the more you get used to it.
Right.
You want to
I have a
rewrite?
friend that wrote that deep IFRS once, but it was a slim chance he can get. He just got 50 on the dot.
I know somebody that is so good in
I got
IFRS.
39.
Wow.
He's so good. This guy.
But there's one particular standard that is very problematic: deferred tax, income tax 12.
See,
No, deferred tax.
income tax. Even during my time, I
Deferred
even
tax.
got
Now
it.
they call it
Should I
problematic.
tell you why I got it
It's
easily?
not.
Because of this guy, Prof K.
It's not.
Prof K, I can say he knows every standard. He will just be saying it like this. He's one of those energetic teachers. Bobomi, tó bá ti link IAS 16.
Okay, this is the method of teaching.
I go for my IFRS class. I read on my own the last time. I tried to attend.
What is his name?
Class.
Prince
Cashmere.
I
Cashmere.
couldn't keep up because my
Prince
wife
Cashmere is
just
very
did
good
it,
in that.
so I couldn't keep up. I just stopped. But I'm looking for.
If this Prof K still has time, I doubt you after. It's already like a big boy.
For me, like that IFRS 17, I read it on my own. As in, read it very well, at least to the
All
extent.
these things I knew once you say 17.
Even this
I'll tell you
even
what.
this IFRS 17,
Now,
there's also a place that said that.
I went for an interview after my
for you to recognize the asset, for you to recognize the lease item as an asset,
week after my
is-
time.
the asset should be greater. I think it should be of greater useful life of that asset. If it's a low value item, you don't need to recognize that as an asset, but you just have to expense it.
Yeah, as an
profit or
operating
loss.
lease.
Yeah,
Like an
so-
operating lease.
Thank you, operating lease. So those
Yeah.
people who have done it before, who have been expensing it as an operating lease before, they will not, once they start in IFRS, they will have to do a rewinding back
Okay.
of those operating expense and that
Yeah,
lease
and
expense
recapitalize.
and recapitalize and do adjustment to retain earnings. That is using IFRS
Yeah.
1. So those are the, it's just that the IFRS itself, one now just because that one is a specialty on its own. One may not want to be going down to be reading or studying IFRS fully, reading other things. So that's why I really left it. I just said, let me.
Oh yeah, let's continue. So we are still going to discuss about all this as we actually gather the inputs. But let's start the inputs.
Okay.
So what are the composition? I've dropped this my file in the group.
Okay.
If you want to follow along, I think I should stop. This thing is long. I should stop it.